Good afternoon, everybody, and welcome to another 3 o'clock live with Max. This week we are joined by the lovely Kate Faulkner, she's renowned. She's a property expert. She really is a property expert, definitely. Today we're going to be looking at where the UK market is going next. Kate's got plenty of slides to share with you. As always, any questions, please pop them below in the comments and I'll be keeping an eye out for them. What we'll do is we'll go through the questions at the end, just in case your question gets answered later on within the presentation. As you know, we've had Kate on before. She's got plenty of data and she's also got plenty of answers. So we should be good to go on that one. Without further ado, I shall hand you over to Max, who will do a further introduction, I believe.
Thank you very much for joining us yet again. And Kate, thanks a lot for getting some really fantastic stuff together. I've had a little peek at the graphs, so I sort of know what's coming, so that's good. And also thank you very much for taking this on, because maybe some of you know, but I've been suffering from COVID since January 1st, and it's taking a little bit of time to get over, so I may suddenly glaze over. At that point, I won't be saying anything. So, Kate, thank you so much for doing all the talking on this one. I'll hand you over with no more ado.
Right, so boy, have I got some slides for you today, and more than that, I have a ton of data, and I have some which is literally hot off the presses. So if somebody could give me a wave to show me that you can see the slides, because otherwise you'll just probably see. So I did a presentation the other day, and about 5-10 minutes in, when I'd caught breath, they turned around and said, "Kate, could you share the slides, because all we can see at the moment are your nostrils."
Excellent. And what lovely nostrils they are.
The slides are definitely there. I can vouch.
Excellent. Right. So here we go. And I'm going to rock and roll and rattle through these. But hopefully, all I want you to do is to go away thinking, right, I kind of get what's happening now, so that you can make the decision that's right for you, whatever that might be. As to what to do with your portfolio, or whether to come into the market, whatever it is that you're after. So what I do like to do is just look at everything I did last time, and Max and I have been working together for some years now, so we go back a way, and I always check out the last presentation. And last time I think we met, there was this highly infectious strain of the virus. Schools then closed. We entered the third, and what we all know is this grueling longest lockdown. And really what we found out post-Christmas was the government had pretty much given up, I think, as his personal view, on trying to balance the virus and the economy, realizing this thing is just so hard hitting that it just wasn't possible. And hence we were into the lockdown. Now, I kind of love this slide, because you look at it, and this is where the kind of papers just go apoplectic in terms of, oh, the world's coming to the end, etc. The weird thing is that when you're talking and listening to all the economists, what they're all saying is, despite the fact that this is the biggest crash, and you can just see those numbers there heading downwards, way worse than 2007. Whoever thought that the biggest crash in 300 years would be perceived by anybody as good news? But it has been, because people predicted things would be a lot worse. So in an extraordinarily weird way, what this does is it also gives confidence, and so much of the economy, and especially property, is all built on confidence. So we actually, although we ended up in the year with this terrible sort of economic, where the UK economy shrunk so much, actually it didn't shrink anywhere near as much as would expected. And of course we all know, despite, and I've got some fantastic figures to show you what has happened since April last year to the forecasts. And it's kind of almost, it's slightly mind-blowing on the one hand, but it's also, for anybody out there that thinks, oh, I wonder if prices will crash, I wonder if nobody's got a clue, quite frankly. But I'll give you a little bit of an idea of what I think's going to happen. But we've just had this unbelievable boom. So these are all the regions, but let's worry about the one that you're in, which is typically the East. Latest data, you're over 300,000 now as far as average house prices. cracking change in house prices. If you've been in the market since 2007, you've seen a 48% increase. That is really, really good news, because what it means is that any of you who have 100% cash ownership, your property is rising at a faster rate than the cost of living. And when you look at everybody below you, southwest upwards, it's not, because inflation is around about those levels since 2007. So anybody with cash there has actually made no money, and actually lost money if you think about it, because they'd have to sell, have cost to buy in and sell. So good news is solid area for investment, because you've got that natural sort of boost in house prices. And you can see you've got maybe not the highest of growth as yet, but that's partly because you're tipping the sort of higher level. You're over that 300,000 now. That will now limit where that money can go, because you've got to get people in at the bottom. And so we've seen the east, the southeast, and London house prices haven't gone up as much during the pandemic. They've had a great time, 7% rise, as you can see, versus previous years where you'd only normally see a 3.5% rise or a 3% rise. So that you've got double the rise in house prices that you would normally see. So anybody who is sitting there on a portfolio since this time last year, yay, you've done really well. So that's really good news for you. And don't worry about the fact that other people have done better, or other areas have done better, because that's because they've had a worse performance since since 2005, actually, where it goes back. So this is all fantastic news. And local prices, you look at these in kind of more detail. So for those of you in Cambridge, Huntingdonshire, Peterborough, not so good, but then that's more of a yield area potentially than capital growth. And there, you know that there will be certain properties on certain streets that will do incredibly well. So you've got an area east of England that you can see there outperforms England as a whole, which is fantastic. Cambridge runs away with itself, but yields always a little tricky to get in a good place. And then you've got Huntingdonshire doing very well, Peterborough not so well, but then you'll earn that little bit more from income, and you just need to be a little bit more canny about some of the areas that some of the streets that you buy there, and that's obviously where Maxine's expertise comes in. So the reality is it's been a fantastic time for those of you that have already been in the market. And you think, if you'd kind of thought this time in April, you thought, oh no, there's all this bad news, which I'll show you in a little minute, about house prices, and came out in May and thought, I'll sell, that's what you would have missed out on over the last sort of 12 months or so, and a little bit more besides that's coming up, which I'll talk you through. So good news for those of you that hung on. It was well worth doing, and well worth trying, if you like, not to play the market here. Buy-to-let is definitely a long-term game, and those that stuck with it have done very nicely at it. In the main, rents have also risen. So this is data from the Office of National Statistics. It's very, very good data. And what it shows you is that in England, where it starts off, it's the rise each year. So it starts off January 2012. We looked at a 3% increase year on year. And as you can see, that goes up and down. So it went down to about 14, 15. And that's because inflation went quite high and wages weren't rising that much, because we were sort of only just coming out of the recession. And any time when inflation rises higher than wages, that tends to suppress rents. It's a bit of an average saying that, which I don't like, but that's a trend that we definitely see. Then as the economy improved, you can see rents rose a little bit, so up to the 3% level. And now, understandably, because wages are squeezed that little bit more, on average, and you'll see for a minute why averages aren't always a good idea, then actually England has done pretty well, and so is everywhere else. So, and again, I love this chart. I love presenting it to anybody that's an MP accusing you evil landlords of your skyrocketing extortionate rents, when I point out that actually their own data from the government shows that that is a pile of rubbish, and actually rents are a lovely market to work in, because they're what you call a perfect market in economics, in that they can't rise more than wages, and that's an ideal situation. Unlike social housing rents, by the way, which rise in line with inflation, and typically therefore when inflation goes up will rise a lot higher than private rents. But I could talk about that forever and a day. However, here's what's slightly more exciting. So these are the actual figures, and one of the reasons I love working with Maxine is that she is so transparent about her figures, and lots of agents are accused of not being, but you always get how it is as far as Maxine is concerned. So it's important to understand that these are averages, and although you'd look at that and think, well, if I'm in a one bed, this isn't good news, it's because there's we've got a 2% decline, and then you've got some smaller increases for 2 or 3, but then this big increase for 4. One of the reasons for that is actually because, unlike the accusations you often get, is because landlords were really kind and fair to people this time last year. And Maxine, they looked after them, didn't they?
Oh, absolutely. Absolutely. I wrote a blog this morning about how the market had changed since March last year, March the 23rd. And the thing that really came out of it is when we started on this journey of looking at what people could afford, what was going to happen, we were hearing about, I use the word Armageddon, because that's what the media was saying. No one's going to pay their rents. Everybody, it's like, no, they didn't say that about mortgages. No one's going to pay their mortgage. And it's like, well, that's strange. But anyway, that's me media, stop it. So it's really a case of just going that there were so many people that were giving us such a positive message. You know, does my tenant work for the NHS? I don't want to charge them. Let's take it down. Are they on 80%? Fantastic. I'll take the 80%. Do they need any other help? And it was those conversations, I think, really buoyed up the team at a very difficult time because nobody really knew what was going on.
No, and I think you did one of the I don't think every agent did this, but for also what I would say is for anybody self-managing, the data definitely says that if you are with an agent, a good agent, then you are much more likely to be paid than if you were a private landlord. Now, that might have been choices that everybody was making along the line, as we're seeing here. But you know, the good news is that everybody was looked after, and in the main, the you know, the real quality agents that I work with have had very little problems whatsoever, which is great news. You know, and that is partly down. I know you don't think the government do anything for you, but things like furlough, things like universal credit, that has definitely helped landlords receive their rent as they would ongoing. But sometimes it's really the devil is in the detail, which is why when I do my work and I'm talking about specific areas, I have to work with an expert like Maxine, because otherwise I would distort. Oh, sorry. There we go. Should have turned that off, shouldn't I? Naughty girl.
Is that the theme?
Hey. No, I don't. Do you know what? I don't. That's changed. That's not my normal theme at all. It's probably quite a good job because it's quite a bit of an upbeat, bouncy, get up and dance thing. So that I'm always happy answering a call. So yeah, I'll have to go and sort that out afterwards. Anyway, apologies everybody. Totally unprofessional. So, but the really important thing is this is the detail. This is the detail that landlords need, and this is one that I think you picked out, Maxine. Is that you know. This is just whatever those averages show you. They're never, ever going to be good enough data for you as a landlord with your individual property. The only person that can tell you what's happening is somebody like Maxine. And that is crucial. So you can see how the value in August 2020 last year, and now it's a 15% increase. And that's virtually unheard of in rents. Rents normally, I've been tracking them since 2007. Maybe plus 4%, minus 4% for various reasons, but it's never at this kind of level unless you've got a very wealthy bracket that you're renting into typically, and a big shortage of supply. And that's the kind of market that the government doesn't always see. It just assumes everybody's in it because they can't afford to buy, and often I find that a sort of utter rubbish. So really important that whatever averages you're seeing at the moment, both on prices, and I know I've put them up there just for information, but you will have every property on every street is going to be different now from a price and a rental perspective. So you've got to get that advice on what the right rent is moving forward. Even if you're self-managing whatever and you use tenant find, talk to your agent before you set the price and make sure that you're doing it correctly and asking what you can. So that's kind of where we are, and I always think it's quite good just to get our feet on the ground as to, well, what's kind of happened to date. But actually really what you're all here for, and what I thoroughly enjoy playing with, is all the numbers that kind of says, oh man, where are we going to go next? Because that's the kind of really exciting stuff, and to see if there's any chance that we could get any of it correct. So big exciting first thing that's going to happen now is the opening up of the economy. This is just like a slightly better picture than I could do with words, because I'm trying to move a little better to that. So we have got this stepped process up until June, whereby the market is going to open. And yes, it might get pushed backwards, but at least we've all got a little bit of an idea of how things are going to move forward. And for every one of these boxes and dates that we're opening up, basically what this means is more money in people's pockets, and the huge extra amount of savings that particularly the over 35s have got, I think, are going to rush back into the economy, which is great news, because the more people earn, the more people have saved, that always drives prices, and that always drives rents. So it gives me confidence really that the market must move upwards into the future, because if it's held up as well as it has done now, when our whole economy shrunk by 10%, there's something pretty special going on with a property market that can go in totally the opposite direction, which of course it's never done before. So this is a complete kind of game changer. So the good news, what this says to you and this opening up, is money in people's pockets, savings coming out of the bank account and being spent on with businesses that have struggled to date. That means more income to pay more rent, and potentially higher house prices. So that's which are obviously your consideration. And of course, the joy is that I think after 21st of June, we can go back clubbing, Maxine. I'm sitting here thinking I can't remember the last time I went to a club.
Yes.
And I'll tell you a funny story. I was with a mate and we went to a club. I think it was Plymouth or something. And I turned around to him. I said, God, I said, just these, they look like 15-year-olds. I said, is it just me? And he turned around and he went, oh yeah, it's because you're getting older. We went in and we tried to order an alcoholic drink, and it was under 16s night. So there we go. Slight complete aside to that. So just don't go out on an under 16 tonight if you fancy a drink. So what is this graph about? Basically, we showed you the economy had shrunk by 10% at the end of last year. And really what we want to know is, when does the economy get back to where it was? And that you can see all the different forecasts, and some of them have been pretty pessimistic. And where we're at the moment is that things are pretty much more optimistic. So the line you want to look out for, the black one, where it dips down in Q1 2020 and up again, and then you're coming into this quarter now, and you can see the blue line goes down and then it comes back up again. So the one pretty much in the middle. What that is basically saying to us is that the market should be returning to its real level in a year or two. So this is really good news that we can start kind of coming back up. So that's what we're kind of hoping for, that it's not going to take us too long to get back to where we were. And again, that's important because although the property market has shifted in the opposite direction to the economy at the moment, at some time the economy is going to go up and property is going to kind of balance out in some way, shape or form. So we do need the economy to recover. And the good news is that looks like that's kind of on its way in the next few years. So that's where we are as far as sort of money coming in and going out. Unemployment always critical, of course, because you can see how much that spooked lenders, for example, last year when they kind of withdrew 5 and 10% loans to value, because you take those people out the market, and of course that doesn't necessarily boost house prices, although again, we had the opposite effect, but eventually that has to come in. And we were looking at some pretty horrendous potential of sort of over 10%, whereas now we're looking at, you know, just around sort of 5-6%. Horrible for anybody it happens to, of course, but this is a pretty sort of decent forecast. And again, just following the economy, which is basically what they've done with the employment figures, that should be back on track within a few years' time. So we're looking at decent year this year, because we'll get this huge bounce back, but then it will take a couple of years after that for things to kind of return for whatever the new normal we have. And of course we have, well, this welcome to government borrowing. Gosh, I wouldn't like to be running the economy at the moment, and fair play to Rishi Sunak for doing what he's doing, because that's a serious amount of stress on somebody's shoulders, as well as a few others. So you can see that we haven't actually, again, the blue line, we haven't borrowed as much as we thought last November, which is good news. And again, that's because the economy has performed better during this third lockdown than was expected. And there is the plan. I think that's a bit ambitious, if I'm honest. So I think he's going to be a bit harsher on taxes into the future. But at this moment in time, they're hoping sort of borrowing can get back to what they hoped it would be before the pandemic hit in a few years. So basically, we're looking at a couple of years where it's going to be a little bit rocky, if you like, but property is still looking to be very solid in terms of the way it's moving forward. So let's have a little look at that. So I know there's lots of, this is actually a precursor to where there's lots of stats. So let me explain what I'm trying to do. So Knight Frank and Savills have been brilliant. As soon as the budget came in, they ran away. Their guys have crunched the numbers. And what they've done is they've come back with what their estimated forecast is, based on the new 95% loans that are coming in back in at the start of April, and on the change to the stamp duty. So we've got this great stamp duty extension. So, and what I thought would be really interesting, particularly for those of you that are thinking, oh, we're going to get a price is going to go down, what's going to happen? They're going to have to fall at some stage, and they will have to at some stage, but at the moment we're not seeing that. So back in April, when we were in lockdown and Knight Frank staff had lots of time to sit behind a computer at home and go nowhere, these were the predictions that they had for 2023, 3% falls across the UK, 2% in London. They haven't put out their regional ones yet, but as soon as they do, I'll send them out. But in actual fact, look how wrong they were. And this just shows you how trying to make an investment decision in particular based on what's going to happen to house prices, it's not, particularly with a buy-to-let investments that's a long-term 20-25-year investment, it's not a great way to try and make that decision. And it's for this reason, if you'd listened to Knight Frank and decided not to buy in June when you could do, then you'd have missed out on potentially 8.5% growth in your first year of your investment, and 3.5% slightly less in London. Now, interestingly, their forecasts in April, they're not far off actually. So in April last year, they also put out a forecast that said they'd see a 5% increase in 2021. And they're saying, actually, we think it's pretty much the same, but they're looking at some regional differences. So I think the prime market, I'm not an expert on that, to be honest, has suffered that little bit more in London. Hence, you can see that big, they were expecting a big bounce back. They're not expecting that huge bounce back this year. And that's quite possibly because the pandemic's going on for longer. So people in prime central London are much more heavily invested from abroad. And clearly that's going to be a little tricky. So that's kind of some little figures. So let's get on to the most exciting page. Look at this. Just sit there for a minute, soak up all those beautiful numbers. But again, what this reinforces is trying to play the market. Really tough thing to do. So in June last year, Savills came out and said, in 2020, house prices are going to fall by 7.5%. So you imagine you go, oh no, I don't want to do that as a landlord. Rush out, sell your property. Well, you'd have been kicking yourself something chronic now, because in the east of England, you'd have missed out on that fantastic 7% growth that you've got. And what they then did in the same time in June, these were their expectations for the market to grow back. And the reason they thought it would grow back so much, so let's take the east of England. So we've got This is June, remember, so they're saying prices will fall by 7.5% in June, but in actual fact they rose by 7%, did the opposite, completely the opposite. They then thought, because they'd have seen that 7.5% fall, they expected that to be counted out by the fact that they were expecting an 8% increase in 2021. Then when they came out with their new forecasts in October, because you'd had that huge 7% rise in east of England, they felt the economy was going to be quite hard hitting. We'd got the end of the stamp duty extension being the end of March. Expectations were things would dip for 3, 4, maybe 6 months, and that we'd pretty much end the year on the same. And I would totally have agreed with that forecast at the end of October. But here's the difference that the government budget is expected to make to the market. So you've got your 7% growth now that you had last year, and instead of nothing this year, they're expecting another 5% growth. So this is why trying to play the market doesn't always work, because you would have missed out on 12% growth potentially, if they're right, over a 2-year period. And hanging on for another couple of years to have got that growth financially has got to have been worth it. And the really interesting thing is when you look at these are the sets of their 5-year forecasts. So again, let's take east of England back in June. So this was all doom and gloom. They're expecting a 10% growth over 5 years. And that was exactly the same as the previous year when they did their forecasts. So they were expecting over a 5-year period that the pandemic was going to give an initial hit, then prices would recover exactly the same rate. What's actually happened since then is they then expected it to be 17%. And I can't actually, bizarrely, I've got pictures of it. And yes, so we're looking at 17%. So we're looking at the same level of growth. So basically, Savills have been saying all along to people since June last year, do you know what, if you hang on for 5 years, you'll get this, it might be a few ups and downs in between, and in actual fact it's all up so far, but you're going to get a 17% growth in house prices. Now they might be right, they might be slightly down, they might be slightly higher than the actuals, but at least it gives you a little bit of an idea about what, if you hang on, is it worth hanging on? Maybe you're a bit fed up, maybe I don't know, you kind of just think, or you're worried, I don't know, about capital gains tax or whatever. What I would say is, whatever decision you're making on property, make it a financial decision. Don't do it based on how you feel or because you're fed up, which I understand. Make sure, because basically that property, you've put money into it and you want to get the most money you can out of it, or the amount of money that you wanted out of it to do with whatever you wanted. So when I invested in a property down in Reading, my aim was to see the capital growth grow enough to be able to add a large extension, to pay a large extension on the end of my home, and get the extra money. So that was my strategy. And we sold it about, I think, 2/3 through, pretty big rise. So we could have held on to it and got a bit extra, but we had what we needed. So that's the kind of way I've worked, and I hope that's helpful, because it's very scary to make decisions, I think, whether to go into the market now or whether to come out of the market, if you haven't got some solid figures kind of to at least work with on that. So I hope that's helpful. And I just thought it would also be interesting to put up the different levels of growth over the last in 5-year slots, just to put the latest expectations into context, if you like. Huge growth 2000, 2005. I could do another hour on why that happened, but pretty much every house across the country at least doubled in value. And that was because of huge amounts of money pouring into the market. But what you then see is it didn't do so well in the next 5 years. And this is the way property goes. Just think of it as a massive sea, and you get a gigantic tidal wave of going up. Then do you know what? That has to be starved a little while, because it is still affected by people's incomes and the economy at the end of the day. Some better growth in the next 5 years, and much better growth 2015, 20. Now that's of course because pretty much every area starting to recover from the crash in 2007, etc. And what you're seeing really over the next 5 years is the expectation expectation that house prices will grow almost in line with the same amount as we've seen in the last 5 years, which, considering the massive kick in the teeth from the pandemic, that's pretty impressive. And now it's your decision that you've got to take that information and you've got to decide how much you trust it, and how that's going to help you. Do you get in now? Do you resize your portfolio, take some out but leave some in because you fancy some of that growth? You've got to do what's right for you at the end of the day. Transactions is something we don't always talk about, but they are underpin, of course, what happens to, in particular, to house prices. And as far as kind of this was more to sort of think about, well, this big rise that we had last year, is that kind of going to last? You can see that they're expecting it to remain for this year, but there's only so many moves that people can make. And what this shows you is, going back, we do about 1.2 million moves we're expected to do. We did about just over a million last year, just under 1.1 are expected to do a similar 1.1 this year. And basically what we know is that, and you can see on here, is when we dip below, we go back up again. So we're just slightly below, but actually that will be compensated in the next few years when our average transaction will very easily go back to the 1.2 million. So again, this underpins the kind of market that those transactions are going to happen. People can still afford to buy and things like that, which is great. There was a lot of talk about landlords selling up, and the media love to grab a story like this. So my view is, well, let's go in, let's have a little look to do that. And obviously the most important thing is to chat to Maxine, because Maxine will know this better than I and better than any statistician across the country as to what's happening in her area. Interestingly, yes, there is some evidence they are, but I put a lot of store by the home track data. They do some terrific reports on a very general level. Again, you saw with that property that we put up going up by 15%, you've got to have somebody like Maxine by your side to understand the local market. And in actual fact, when Home Track ran the numbers, yes, some are selling, but it's less than 1% of the PRS stock. So don't be led by what comes out in the media. They're just looking for stories. They're salesmen at the end of the day. They're salespeople. And I think, Maxine, you were saying some of the landlords that have maybe been in the market for 15, 20 years, they are deciding, yep, that's it, got my money's worth. But you're seeing really younger people coming in, and that belief in the property market being sustained.
I think, yeah, people work the figures out. I mean, certainly you're not going to earn anything by leaving money in the bank at the moment, and can't foresee that happening going forward. And then with the call of potential negative interest rates, that's another interesting little thing. But I think just people, they understand it. I mean, I'm very much a bricks and mortar girl. I've been doing it for years. It's something that I feel very comfy with, and I can see the benefits. So it is really as simple as that. And you can't talk somebody into it. They've got to see the figures for themselves. Yeah.
No, that makes perfect sense. So don't hold too much store by the stories. And I'm afraid there are more legal things on the way. Nobody earns money for nothing, and certainly not in our industry. And I bet you don't feel like that, Maxine Lester. So we've got the new electrical rules still due. You've got the Renters Reform Bill. I mean, what's quite interesting is we've almost had a taster for what happens if Section 21 is going to be banned, and what happens if eviction is going to be, it's going to take 6 months. We've kind of had a taster in a little bit of a weird way. It's actually worked okay in Scotland. It hasn't had the impact that I thought it would, for example, or anybody else. So I don't think the Section 121 changes, we know they're coming in and that it will be abolished in some way, shape or form. But actually, we also know that the reality is it's not it's a pain if you don't plan ahead. And if you're hoping that you can ask somebody to leave in a couple of months and that changes, but as long as you're planning ahead well enough, it shouldn't be an issue. We've got these EPC ratings. There's a consultation now at the moment trying to get it to C for 2025. My attitude is, if you're buying anything now and you're renovating existing stock or new stock, whatever you do, get it to the highest EPC rating you can. My philosophy is, if you reduce the amount of heating bills that your tenant is going to pay, guess what? they've got more to pay you in rent. So it's a no-brainer as far as I'm concerned. It is also out of interest, probably, and it hasn't happened to date, despite everybody saying it would. It may impact on house values in the future, because for the first time, there's a big consultation out about lenders having to run their books against the EPC levels. And that's going to get really interesting. So the message is just get your property to the best EPC rating you can. And don't think of it as a cost. Think of it as an investment in receiving rent rises in the future, and potentially holding the value up of the property, of your asset you have. And I'm afraid the government, we cannot, it's like banging our heads against a brick wall. We cannot get them to come away from this idea that reducing the PRS in favour of home ownership is hurting particularly vulnerable tenants. And I don't know why. I don't know what we're doing wrong. I've tried. I'm quite a good communicator, and I've failed, I'm afraid, as we all have. But it's not for a one to try, and it really isn't. And we're going to keep going. Interestingly, on the home buying and selling side, and some of the changes that we're doing there, we're flying with the government. They've been fantastic, hugely supportive, and we've got some cracking changes coming up. It's going to make it much easier to buy and sell in the future. So again, this is only information that I could ever get from working with Maxine, because all the averages that I have on this are utter rubbish, quite frankly. And I'd just be telling you almost porcupines, although I kind of wouldn't know it. So Maxine, these are very much your figures, but it's not a surprise, I guess, really, statistically, when you can't ask somebody to leave for 6 months and you're not allowed out, that the average tenancy's gone up to 40 months. But you know, that's great for you as a landlord. But here's the really interesting thing, is 30% less properties on the market. Well done, government. How much have you helped tenants? That was a genius move. And this has to impact. The government's got to recognise this in some way, shape or form. You cannot, as a government, try and force a reduction in demand of a private rented sector when there's a growing population, and our proportion of that growing population want and need to rent. And that is the fundamental flaw with government policy at this moment in time. And at some point, whether it's 6 months' time, several years down the line, that is going to have to really bop them on the nose for them to be able to see it. Not seeing any more landlords selling. It's the same number as normal and new landlords are coming in. So the stock is staying at 30% lower than it was, but tenant demand's up by 15%. You know, the government just can't force a market down when you've got statistics like this to show them. I think, Max, you were saying marketing of rental properties will continue to change, and I'm guessing that's quite news with virtual viewings and things.
Yeah, it's the technology. I mean, in some respects, what's happened with us, we've most probably moved our technology on by a couple of years, in a couple of months, because where we would go, oh, no one wants to do that. Oh, yeah, no. It really is a case that that's the only way to do things. And we are finding people like it. People like that initial, okay, we'll take them around a property virtually. They can basically then decide whether they want to sort of say put themselves forward to actually move into that property. And that was really a case in point of that one in Hertford. I think we had something like an audience of 18 people. We had 10 offers, and then it comes back to what you were saying about wages. You know, the rents won't go up unless people can afford to pay. And we understood the budgets that people had. We had a very, very good product there. It was, a good place. And that's what happens. So it's really a case of sort of, you're going into the market, and technology is helping greatly. And we are going to continue that. Absolutely.
Yeah, and that's great, because I think I must admit I never thought that would have taken off as well as it has. And I was always wondering whether it was going to be stayed. So it's really interesting what you're saying, that actually people quite like it. Because I'm a touchy-feely person, so it would spook me something terrible. But I kind of get, maybe I'm not in that market at the moment. Maybe I'd change my mind now as well, because nobody wants to see anybody anymore, do we?
Well, no, but I think it also it cuts out the things that you'd be looking for, that you go, oh, I don't like that. So it saves people time.
Yeah.
And, you know, yes, people do before they actually take the place. Obviously, they do go and see it. It's touchy-feely because it's going to be their home, and we've got to make sure they're going to be happy there. So it's not just done virtually, but it's just that initial side. We're getting bigger audience to see a property.
Wow.
That's getting more interest in property. The prices are going up.
Wow. Yeah, I mean, that's the classic agency, isn't it? You know, I've always said don't overprice something, because the more viewings you get, the more offers you'll get. And that's kind of, some things don't change, do they? Even during a pandemic. So as I say, as long as the wages, and you're in pretty good nick, I think, for economically, and I mean, fantastic, some of the most fantastic areas we talked about, I know before, about the sort of Cambridge, Oxford Arc, etc. But, you know, you've got some pretty decent economic growth coming forward in your area, which helps drive those wages a lot higher than in other areas. So Northeast, for example, they don't see rent rises, and they've only really seen house price rises this year, to the point that it's only towards the end of last year that average house prices in the Northeast, for example, were the same as they were back in 2007. That means it's taken 13 years for them to recover. So you know that house prices double every 10 years. Rubbish. They have actually stayed the same for 13 years. And that doesn't include looking at the impact of inflation. So in real terms, for anybody that owns property there, it's fallen quite drastically in value. But that's not the position that you're kind of in. So this is kind of my summary, really, for my in-depth expert opinion on the property market. Is it will be a bumpy ride, but do you know what? Particularly seeing the market survive as it has, and people's sort of human reaction to property over the last 12 months has been a real kind of boost, I think, because it's difficult to see how in any way, shape or form the future isn't still bright. Are we going to get rid of price rises and price falls? No, prices will fall at some stage. But do you know what? If you try and run your investment based on what you think is going to happen, there's a team of 25 people at Savills, and you can see that they're on their fourth forecast now in a year. So how can, you know, the likes of us get it right? Get the fundamentals right. Speak to Maxine. Talk your budget through if you want to buy more. Get your portfolio analysed. Work out what money you have. Make sure that you're going to put that into a property that's going to deliver, whether it's income or whether it's capital growth, because you tend to get one or the other until you've invested for a long time. So that's the fundamentals. It's about getting the right help, and it's about seeing this as a financial investment, not necessarily just believing that property is going to fall. You can go in, bag a bargain, then it can go up. I've been watching people do it since Brexit. So they've been waiting for 4 years. And the way I could describe it now is, you imagine that you're a first-time buyer this time last year, and you've saved for 5 years for your 5% deposit, and you're so excited. Then somebody locks you down, and you've got all this time to go and look for property, and somebody's telling you the market's going to fall by 7 to 15%, and you're even more excited. And of course, what they hadn't factored in was, well, do you know what? If somebody's going to forecast the market's going to go down, you ain't getting any lending. And so the 5 and 10% deposits were withdrawn. So all those people who thought, Brexit was going to crash the market, so we'll wait till then. Lockdown and pandemic, that's going to crash the market, so we'll wait till then. And it's all backfired. And it's about doing it at the right time for you. That might be today, that might be in this time last year, and not trying to play the market, I think. And for want of all of the slides I've put you forward, that's probably my biggest message today.
When is the best time to plant a tree?
Yeah,
20 years ago.
Yeah, absolutely. Absolutely. Yeah, and I've got one of those. I'm rubbish at gardening, by the way, so I'm very proud of this fact. But I've got a little cobnut tree in my garden, and I took a little bit, and there's a joke, really. I put it at the other corner. Got a bit of a funny neighbour, and so I put it there. It's this huge tree now. I'll probably never grow anything like that since. So there we go.
Excellent. Well, thank you so much for that. I mean, I think the biggest takeout for me was the forecast where you're saying east of England by 2025 we're looking for a sort of 16 to 17% increase house prices. So from a landlord's point of view, that's your capital asset
Yeah.
going. Once I think people start moving, that 30% difference in properties will change because the churn will start increasing. So that will change the market, may all of a sudden happen in July, but at the moment that's what we're working on. So no, it's really interesting. Thank you so much for that.
Well, know how much I enjoyed putting that together with you.
Thank you. So Laura, do we have any questions? I've written it down, ask for questions.
Have one here from Casey. I think it's a couple of questions all rolled into one.
Oh, great.
Is now a good time to rent in London? First time renters in London, flats available and prices being reduced. We'll go with that one first and I'll ask the next bit.
Okay, so again, people have got to understand that, you've got to make a financial decision for how you put the roof over your head and the cost of putting that roof over the head. One of the interesting things in London is that most people think that it's this huge exodus for London that's reducing rents there at the moment. But actually, the reality is it's a massive increase in supply, we believe, from the serviced accommodation, which of course that market collapsed. Those rentals have come into the market, and there have been some people that decided to rent somewhere else cheaper for 6 months, but it was a boost in supply as opposed to as much a decrease in demand. So there is no doubt that if you can bag a bargain rent and you can tie that in for the next 3 years, and that suits, that's fine. But could you look at buying at this point in time? Because again, prices are interestingly expected to rise a lot more there than they have in the past. I think Savills were forecasting a 4% increase in house prices over a total 5-year period, unheard of. And now they've upped that to about 12-13%. Better in Huntingdon, etc. Again, because you've got the kind of affordability. But if you can bag a bargain rental at this moment in time, and your plan is to stay there for a year or two, then why not?
Thank you very much. And then I think we probably covered some of this bit, but will there be more supply or less in the next 3 months as economy unlocks, and will prices continue to fall?
Oh, wow. Gosh, I'll have to get my crystal ball out for that. So we say continue to fall. I mean, prices are not falling. So yes, you might have seen some falls in parts of London, etc. But decent properties in decent areas are still going for good prices. And in the main, as you saw from the stats, prices are rising. Of course, the difficulty is that if you want to buy, and certainly if you want to get your first foot on the ladder or the investment ladder, you want prices to fall. And I'm afraid, I think there's too many people have hoped for that to happen over the last 3 or 4 years and missed out on some cracking rises. And I remember this time last year, to my close family members, we were chatting through lockdown because they were in the process of buying properties, and we were talking, God, I said, well, look, and what we did was we sat down and we said, what's the worst case scenario? House prices fall by 20%. Where does that leave both of you? And we worked out a plan to mitigate the risk of price falls. What happened? Prices went back up again. Prices went up, and they've done tremendously well in a year when it wasn't expected. So the falls that were expected were very tiny for this year. And you can see from the forecast that they've now very much been reversed back upwards again. But again, the long-term 5-year trend, which is possibly the more useful one, I think, from a property perspective, is that prices are going to do exactly the same, whether you bought 2 or 3 years ago or whether you kind of bought today. You might see a little shift sort of later towards the year, but you always see a little shift later in the year because other people are worrying about Christmas. I always buy in November. If I'm going to buy, I buy in November because people have had their property on the market. It wouldn't have worked last year, but people have had their property on the market for maybe 3 to 6 months, and they're desperate to get to exchange before Christmas. So I always got a good bargain by doing that. So you could kind of wait, but you shouldn't have to. If you can't make money out of a decent property today, and that property deliver what you want, then you've got to probably think if you're being realistic about what property can deliver, or whether it's the right thing for you. because it's this is a 25-year deal, 25-year deal, and you know, prices will go up, down, and stay the same during that period of time. And if you're trying to play it all the time, you know, we'd all fail, because it's just not a market that's very easy to do that in.
I think if I can add to that,
Yeah.
it's, you know, when as people come to me, it's like, you know, what do I buy? We actually start on what's been on Rightmove, Zoopla for the longest time. And okay, if there's reasons, we work out what those reasons are, we can see then the yield, but it's negotiation. It's a negotiation of the actual price. You're not going to live there, it's an investment. And therefore it's a business deal. And you've got to go into that negotiation. This is a business deal. Have your absolute maximum that you will want to pay. Make sure your first offer isn't that maximum. But also, if you know that a property's been on for a while, there could be a reason. But in the main, that's where the bargains will be.
Yeah. Yeah, and that's just wise advice. It's really important to see this as a, I think, you know, not just as I've been saying, but a financial deal. And sorry, I'm just like panicking. A thing that's just said, your battery's dying. I'm thinking, but I plugged everything in. So if I disappear, sorry, my battery went.
Bye.
Did the last slide. I got away with this. So that's the kind of thing that you know, it's about finance, and it's about the best property, the deal that you can do. And again, working with somebody like Maxine, and I stress this because I know how important it is and what a difference people like Maxine can make. She really gets if a property is a good deal or not. Whereas sometimes, particularly if you're investing for the first time, you can kind of think, I think that's a good deal. Maxine knows if it's a good deal. And that's the bit that's important. And you might have missed out. Say, for example, that property came up that had a 15% increase. You might have said no to that deal because you didn't know what was going on the ground. And that's again where that critical kind of local expert knowledge is critical.
Okay. Well, thank you. Anything else there, Laura?
We've just had another one in. It says, what is the current view on HMOs?
Oh, HMOs. Where are you at with HMOs? Are you just you're just going to roll your eyes?
Yeah, no, it's not the sort of market that we're in.
Yeah.
I can see from people that colleagues and things like that it's actually very profitable. However, you've got to put in a lot of work. It's not easy money. And particularly on HMOs, the one thing that you are dealing with is the personalities of the people that you've got in the property. So in some respects, you are herding cats in the main. So it's one of those things. It works for some people, but you've got to be prepared for work.
Yeah, I think so. I think that's true. And in my experience, and we've been monitoring HMOs for a long time now, and it's a very, again, there isn't an HMO market. There's probably 5 different types of HMO markets, and it depends which one you're in. So a friend of mine runs a very much a boutique HMO market where he will rent to people who are studying for a law degree. They've left university, they still want that university life, but they want to pay for a nicer place to live. So very high spec, very much boutique hotel kind of thing. And he does really well. He's really smart and he picks it. But at the end, like Maxine says, there's huge amounts of extra work. He spends like a fortune getting them right. But it's a very long-term investment for him, and it is income mostly that he's after. That's what he's looking for. So if it's capital growth, then HMO's on there. For the main, from all the stats that I've seen, because of the pandemic, and this is where the change might come in, is people don't want to share houses as much as they used to. And as a result of that, most of the forecasts that I've seen and agents and people I've spoken to, the market's as flat as a pancake, or they're seeing rents fall. So anybody looking at the HMO market, you've got to have a real special reason for somebody to rent your rooms because it's there is a lot of oversupply, I think, in quite a lot of areas. So you've got to have that right property on that right road at the right spec and make sure that it works at the amount that people can pay, and that you can keep it as full as possible. But huge amounts of extra work.
Think that answers that one, Laura?
Yep, and that is all the questions for this moment in time. Kate says thank you for answering her question as well. But
Yes, that's
if
kind.
anyone watches this afterwards, please continue to put comments and we will pick them up afterwards, not a problem.
Okay,
Yeah,
well,
absolutely.
Thank you so much. I am now going to hit the sofa, literally.
Don't blame me. Don't blame me. And thanks so much. I hope you feel better, because it's a rotten thing to live with.
I'm getting there.
Good.
I'm not sure where I'm getting, but I'm getting there.
Well, I know how hard you work, so take it easy for once.
All right. Well, thank you so much. And
Pleasure.
we will speak, no doubt, in a couple of months' time.
Yes, look forward to that. See what else the forecasters come up with.
Okay, you take care.
Cheers now.
Bye-bye.